Welcome back to the Texas Home Loan Hustle, where we turn knowledge into cash flow and help everyday people build wealth through real estate. If you're a real estate investor, agent, broker, or just trying to figure out how to make the most out of today's tax laws and obtain solid real estate investment strategies, this episode is for you. In today's episode, I'll be diving into the real estate game changers inside the new One Big Beautiful Bill. And y'all, this thing is packed with serious benefits for real estate investors. Stick around to the end, because I'll also be talking about some of the investor-savvy deals I've closed this year, where my client is cash flowing over $2,000 per property. We are going to cover a lot, so get your pen and paper out so you can take notes. First, I'm going to talk about the Big Beautiful Bill and how the new laws have created more leverage power for investors. And lastly, I'll dive into two deals that I closed this year in Taylor, Texas, and the strategies that can be used and applied in other places throughout Texas. Even if you're not in Texas, these strategies can apply in your area if you're willing to do the work, team up with the right people to help you find profit-generating real estate. Without further delay, let's go. The big picture. What is this bill? This bill is a major piece of federal tax and housing legislation passed just recently on July 4th, 2025. It includes a mix of tax cuts, incentives, and deduction rollbacks, making it one of the most favorable tax environments I've seen in years. We're talking about permanent tax breaks, faster depreciation, higher deduction caps, and new opportunities in affordable housing and opportunity zones. And you don't need to be a big institutional investor to benefit. Even small and mid-sized landlords can cash in on these changes. Why does that matter? Investors typically struggle in areas of project stability, cash flow, and continue portfolio growth. The Big Beautiful Bill helps investors plan more confidently, where you can rely on deductions that will lower your taxable income significantly. Let's talk about some of the key changes in the Big Beautiful Bill benefits that will benefit current and new investors. I'm going to spend a little time highlighting each key point. Whether you're currently eyeing a property but struggling to make the numbers work, or a new investor waiting patiently to get into the real estate investment, I advise you to listen closely and grab a pen, because I'm breaking down 4 powerful updates from the bill that can help tip the scale in your favor. I'm going to spend time talking about each of these new benefits. 1. Permanent mortgage interest deduction. 2. QBI deduction boosted to 23%. 3. Bonus depreciation changes. 4. Section 8, an affordable housing incentive. So get your notepad out, rewind if you need to, because these updates are real and they are powerful. But don't go anywhere just yet. At the end of this episode, I'm going to walk you through 2 real-life deals I closed in Taylor, Texas, where my client is cash flowing over $2,000 per property. They came with 1-year warranties and were rented out to construction crews working on Samsung projects in the area. Real strategy, real results. And I'll show you how it was done. Let's talk about one of the biggest costs for any real estate investor: loan interest. When you finance a property, especially those higher value 1 to 4 unit new builds, you're paying tens of thousands in interest every year. That's money out the door, right? Well, thanks to the Big Beautiful Bill, you now get to write off more of that interest permanently. Here's the deal. The old mortgage interest cap was reduced under the previous tax law to $750,000, and it had a sunset clause. What is a sunset clause real quick? A sunset clause is basically an expiration date that's written into the law. Unless Congress votes to renew or make it permanent, that part of the tax code disappears after a set time. So under the old rules, the mortgage interest deduction was capped at $750,000 and was set to expire, meaning investors couldn't count on it long term. But under the Big Beautiful Bill, that deduction is now permanent. No more sunset clause. That gives you consistency and confidence when planning multi-year investments. Let's talk depreciation. That silent tax weapon investors love. With the Big Beautiful Bill, 100% bonus depreciation is officially back through 2029. That means you can write off major expenses immediately instead of waiting years. Here's what it means for new investor trying get to the real estate investment game. Before this change, the IRS required investors to depreciate big-ticket items over 5 to 15 years, depending on the asset type. So things like HVAC systems, appliances, cabinets, roofs, flooring upgrades, all had to be capitalized and depreciated over time, instead of deducted in the year you bought them. And here's the catch. Under IRS guidelines, any item over $2,500 per invoice or unit must be capitalized, not expensed. unless you qualify under the de minimis safe harbor rules or use Section 179 expensing. That's another conversation. If you would like for me to discuss, add comment, and I'll create a video to discuss later. So that new $3,500 HVAC unit or $7,200 appliance package for your rental, you couldn't just write that off. You'd have to slowly depreciate it, often over a 7 or 15-year schedule. That slows down your tax savings big time. But now, thanks to 100% bonus depreciation, you can write off the entire cost in the year it's placed in service, even if it's well over $2,500. That applies to both new construction and improvements to existing rentals. It's available for both residential and commercial real estate. Example: let's say you put $50,000 into upgrades for a new fourplex, HVACs, appliances, windows, flooring. Under the old rules, you'd spread that over 5 to 15 years. Now, you write off all $50,000 in year one. That could reduce your tax bill by $10K, $20K, or more, depending on your tax bracket. Want to take it a step further? Use a cost segregation study to break the building into faster depreciating components like lighting, carpet, fencing, and fixtures, and combine that with bonus depreciation for maximum tax impact. This is how real estate investors legally show losses on paper while stacking cash in the bank. So if you're buying, building, or upgrading, 2025 is the time to go big and expense smarter. Let's talk about a tax benefit that a lot of small business owners still don't fully understand. The Qualified Business Income Deduction, or QBI. Under the Big Beautiful Bill, the QBI deduction just got better, increased from 20% to 23% for pass-through entities. That's a direct win for real estate investors filing on Schedule E self-employed agents or brokers on Schedule C, and anyone operating through an LLC, S-Corp, or partnership. Now, if you're wondering, how does that actually help me? Here's what it looks like. If you make $100,000 in net profit from rentals or commissions, you now get a $23,000 tax deduction before federal income tax even kicks in. That's money off the top, and it directly reduces your taxable income. Why is this such a big deal? Most small businesses operate on thin margins. The QBI deduction helps level the playing field by keeping more of that hard-earned money in your business instead of going to the IRS. Now, in order to take advantage of the QBI deduction, you'll need to make sure your real estate activity qualifies as a business and not a passive investment. What does this mean? This means you need to be actively working as a business where you have documented activity such as making calls, talking to vendors, clients, handling invoices, or managing the people who handling these things for you. And just to be clear, when I say you need to be operating as a business, that means you have an LLC filed with your Secretary of State. You've got a real EIN. You're filing a separate Schedule C, Schedule E, or 1120S return. If you're not doing that yet, or you're unsure if you qualify, that's okay. I'm not just a mortgage loan officer. I'm also a partner in a tax and accounting company. So if you need help structuring your business, setting up your LLC or S-Corp, or making sure you qualify for these powerful deductions, shoot me a message. I'd be happy to help you. I want to talk about SALT. While we've learned the benefits of QBI, let's add the SALT deduction raise to this conversation now. If you're investing in high-tax states like California, New York, or even parts of Texas with high property taxes, listen up. The SALT, state and local tax deduction cap, just jumped from $10,000 to $40,000 for individuals making under $500K. That means bigger write-offs for property taxes and state income taxes, more incentive for people to buy and refinance in high-cost areas that will result in demand spikes, price appreciation, which means better long-term equity for investors. For real estate agents, this could bring hesitant buyers back into the market, especially in areas previously burdened by tax limitations. Section 8 and affordable housing. I know plenty of my clients in big cities were on the edge about the changes that were coming to Section 8. In the media, they were talking as though this program was going away or was going to be limited. Well, that was not the case with this big, beautiful bill. In fact, to the contrary, this bill strengthened low-income housing tax credits, LIHTC, increasing allocations by 12% and lowering the bond financing threshold. It also makes opportunity zones permanent, giving investors long-term confidence to develop and renovate in underserved communities. And here's where things get interesting. Section 8 funding is actually stable, and fair market rents, FMRs, are going up, which means higher rent ceilings in voucher contracts. If you're a landlord accepting Section 8, this is your time. Higher payment standards will equal better rent income. Important. While there were early discussions about turning Section 8 into block grants that didn't make it into the bill, so for now, the federal program remains intact. If you've been hesitant to work with housing choice vouchers, now might be the time to explore that stream of income. It's stable, it's government-backed, and it's growing. Now let's talk real deals, real investors, and great cash flow. I've heard people say, real estate doesn't cash flow enough. Some say, I'd rather take my money and invest in a business. And I get it. I'm an accountant too, so I've compared the two many times. The truth is, like any business, real estate requires strategy, research, and the right team behind you, and nobody proved that more than my client, Ana Lopez. Ana had never owned investment property before, no experience, no prior rentals. But in less than a year, she closed on 2 single-family homes in Taylor, Texas, just 6 months apart. Now, Taylor isn't just any small town. It's the epicenter of Samsung's multi-billion-dollar chip plant, and there are confirmed plans for a college campus nearby. That's what her broker helped her spot: future demand and long-term tenant flow. So instead of just renting each home out to one family, Ana went creative. Both homes had 5 bedrooms, and she rented each room individually, 4 rooms at $800 per month. Master Suite at $1,200 per month. What inspires me most? Ana is in her late 60s, just getting started, and already outperforming people half her age. She's bold, she's smart, and she built a team that backed her vision. That's what real estate is all about. If Ana can do it, so can you. Do the math. That's $4,400 per home, or $8,800 a month in gross rental income. And guess what? She's renting to Samsung workers, construction crews, engineers, and out-of-state contractors, all who came in for the project. Now here's where I came in as her loan officer and accounting partner. I saw the long-term forecast for Taylor and recommended a 10-year interest-only loan that automatically converts to a 30-year fixed. Why? It maximizes her cash flow today. She's building equity over time. She keeps flexibility, sell in 5-10 years or refinance later, and she can always pay down principal early if she chooses. Some people ask, why interest only? Well, why not if your strategy supports it and the numbers make sense? Interest only doesn't mean no responsibility. It means control and cash leverage. And with the big beautiful bill in place, Anna's going to get massive write-offs this year between mortgage interest, property taxes, depreciation, and operational expenses. Her tax savings are going to be amazing. All right, so what now? If you're an investor, talk to your CPA about cost segregation and using 100% bonus depreciation. Consider shifting assets into LLCs or S-Corp to maximize the new QBI deduction. Analyze your Section 8 potential, especially with rising fair market rents. Explore opportunity zones and LIHTC deals for long-term tax credits and community impact. If you're a real estate agent, educate your buyers on the renewed interest deduction and SALT cap. Work with lenders and brokers to show how affordability is improving for higher-end clients. Connect with investors looking to expand using 1031 or capitalize on depreciation. This is the moment to sharpen your strategy and double down on smart investing. Thanks for tuning in to the Texas Home Loan Hustle. If you found value in this breakdown of the big beautiful bill, go ahead and hit that like button, drop your questions in the comments, and don't forget to subscribe for more mortgage and real estate tips every week. Want to explore how these changes could work in your portfolio? Schedule a call with us at 512-900-5737 or shoot us a message at teamappointersfinance.com. We'll help you make the most of this new real estate era. Until next time, hustle smart, invest wiser.